Good morning, everyone, and good afternoon. So welcome to our UK attendees, and good afternoon, good evening to those joining from Australia. Thanks everyone for coming along, joining the team representing BDH Sterling today as we present to you a great session outlining everything you need to know in 2023 about UK pension transfers to Australia. Now, I know the invite was for everything you need to know in 2022, but we thought we were so close to the end of the year that making it 2023 and making sure we had up-to-date information focusing on the year ahead was pretty important. So we've made that slight change, and hopefully it helps you to better understand what your plans might be for the next year. As we kick off, I'll refer to a general information slide that we have there. Now, it's typical general information warning. The presentation today is based on Australian and UK legislation as at 1st of December 2022 and is information only. It's not tailored advice to your specific situation. So before acting on any of the information contained in today's session, we'd certainly encourage you to seek tailored financial advice specific to your needs. Myself, my name's Brenton Ritchie. I'm the Financial Planning Manager for the Australian division of our business. I'll be helping introduce and facilitate today's session and help with the Q&A at the end. And the most important person today is Rebecca Watson, who's one of the financial planning team from our West Australian office. Rebecca has over 20 years experience in the financial planning industry and has been an integral part of the BDH Sterling team over a good 8 years now, providing advice across UK and Australian clients and advice strategies for everything involved with the client base she deals with. She'll take us through the main content you need to know about transferring pensions to Australia in 2023. So today's agenda, we've broken today's session into 5 key areas. The first being types of pensions and why to look to transfer. The second, QROPS, which is an acronym for Qualified Recognised Overseas Pension Scheme. The transfer process is section 3, so what it takes to transfer across and why advice is important. BDH Sterling, where we can assist with that process, and a Q&A session. So we'll look to answer as many questions as we can at the end, and to be able to log your questions along the way, please feel free to type your questions in the Q&A section, and we'll make sure we try and answer as many of those as possible. If we don't get through all the questions, we'll certainly look to come back to you with any specific questions and give you answers to those post the webinar. We do expect we'll have you back on your way today within the hour time frame. So we'll get in and get started with Beck taking us through the first section.
Perfect. Thanks very much, Brenton. As Brenton mentioned, my name's Rebecca Watson and I work out of the Perth office. And I've been with BDH Sterling for 8 years now. So today I'm going to be going through the presentation and navigating you through some things that you need to consider when you're looking at transferring your pension, some do's, don'ts, and some legislation points that we need to make you aware of as well, and then obviously how we can assist. So many of you that are on the call, I'm assuming you have all worked or lived in the UK and have a UK pension, hence why you're on the webinar today. So there's a couple of transfers a lot of people ask what can and what can't be transferred out of the UK and across into Australia. So the first slide just shows you a couple of pensions that can be transferred. I'll go in a little bit more detail around those in a second on the next few slides. First of all, you've got company pensions. So these are pensions that you have accumulated whilst you're working in the UK. They can be defined contribution or money purchase schemes, or they can also be defined benefit schemes or final salary schemes. You may have heard of them as well as. Also, you may have private personal pensions, so it may be a personal pension that you've consolidated together or you have set up yourself and you contributed into those whilst you were living and working in the UK, or it could be one that your employer was paying into as well. There's also funded public sector defined benefit schemes, which I'll go into a little bit more detail as we go through on those. So those 3 types of pensions can be transferred to Australia, but the ones that we are a little bit more restricted in being able to move into the Australian superannuation environment would be the ones that are listed there, the 5 ones we've got there. So the first one is UK state pension. So this is based on your national insurance contributions, how many years you are making those in the UK, and then at a pension age, which for most people is age 67, you can then draw a pension from the UK state pension. Now, it is important that you can't take a lump sum on this one. It will just be pension payments, but obviously will assist you in your retirement objective of that income that you're requiring. The other ones that can't be transferred out of the scheme are the government unfunded pension schemes. So some of you on the call may or may not be aware, or may not have one, but these are like your NHS, teachers' pension, army pensions, police pensions, and some civil service pensions. And I'll talk a little bit later in the slideshow, the webinar today, around why we can't transfer those out. But you still will be able to draw an income at retirement age and or a lump sum. The other one is if you've got a company pension that are in the pension protection fund. Now, you will be aware if you're already in this fund, but that cannot be transferred out either. If you're already drawing a pension from a company pension already, so you've already started drawing down those income or lump sums, you wouldn't be able to necessarily do a full transfer over. And again, an annuity is something that you may have purchased, and if you've got that, you may be locked into a lifetime annuity. So you wouldn't necessarily be able to do a lump sum transfer over. But again, it still will provide you with some of your income requirements later down the track when you start drawing those. The next bit just goes through the types of company pensions. Like I mentioned previously, you may have a defined contribution or a money purchase scheme. These essentially are pots of money that is invested in line with your risk profile. So it will be as risky or non-risky as your tolerance or what you've decided to invest your money into. And the idea of that was that that will build up a pot of money so that in retirement, you can then obviously draw an income to fund your retirement needs. The other one is the defined benefit scheme. Most people, you may know if you've got one of these or not, but this will provide you with an income for the rest of your life. It's a guaranteed income, and it's based on the salary that you were receiving from your employer and how long you were with the employment scheme. So most of you may know that. If you don't, it's something we can assist you in looking into. The defined benefit schemes won't necessarily give you a fund value. It's basically going to give you an income with a lump sum option. You can request a transfer value though. So they call them cash equivalent transfer values or CETVs, and they usually only last for 3 months. So you have a window of 3 months to make a decision whether you want to come out of that defined benefit and take the lump sum on offer, or if you would like to stay in the scheme. The next few slides is just going to go through a few points on why you may consider transferring out. A lot of people come in and see me and say, well, why would I move my pension from a UK scheme that's giving me X amount of income in retirement into an Australian fund? So one of the main things that is a benefit to people is around currency control. So I'm sure every single one of you on this webinar today have looked at currency at some time, and probably just before you jumped online maybe. The graph that's in front of us, it is only over a 5-year period, so it runs from 2014 to 2019, but it does show a high of $2.20 to the pound and a low of $1.60 to the pound. At the moment, we're sitting around the 179. So obviously, currency market goes up and down, and this can affect your income that you do receive in retirement. So at BDH Sterling, we do discuss with you around trying to eliminate that long-term currency risk and the importance of knowing what income you will be drawing once you're retiring in Australia and, taking that in Aussie dollars. So something that we consider is the currency control. A couple of other points and it will depend on the pension that you have. It's around estate planning. So if you are in a defined benefit, for example, or a final salary, if something was to happen to you, your spouse may receive 50% of the pension that was guaranteed in lump sum to yourself. If you have dependent children under the age of 23, they may receive a portion of that pension as well. However, if you don't have a spouse and you don't have any dependent children over the certain age of around the 23 years old, potentially that pot of money cannot be left to your estate, and it would obviously go back into the scheme. So for some people, it is important to protect spouses and children if they're dependent on you as well moving forward. So that's something that we need to consider. The other thing is around scheme funding deficits. So some of you may or may not be aware, but some funds are underfunded, and there is a risk that you may not receive your full pension as promised by the scheme. So that is a risk that we need to consider when we're looking to transfer out. The other thing is investment control. So it's important to lots of people to have control on where your money is invested, to understand what sort of risk that's associated with, and how much money that potentially will return you throughout your retirement to meet your income needs. It goes the other way, which will come up on another slide, but I'll talk to you about that. But final salary scheme is a little bit different. But if you're in a defined contribution scheme and your money's invested, you might want to take a bit more control on how that's invested, and also what currency that's invested in. So whether it's invested in sterling or it's invested in Aussie dollars. The other thing we need to consider is the tax treatment of the benefit. So at some point, whether you leave it in the UK or you take it over, there will be some tax treatment of that benefit you take out. By moving your money to Australia, a large portion of the money that we look to transfer from your UK pension to Australia is considered a non-assessable tax-free income in retirement. So some people do know this already, but not many. But in Australia, if you take money from your superannuation as a pension, it's not taxable, and there's no limit to what you take out as long as you've got the money to fund your long-term retirement needs. So by bringing it from a tax retirement in the UK, if you left it there, it would be taxable. If you moved it to Australia and drew it out, it would be tax-free. There is a small growth component on an onward transfer to Australia, but I'll talk a little bit about that in a couple of other slides. The other benefit is to consolidate your pension. So reducing overall fees, you might have 2, 3, 4, 5 pensions in the UK. So it might be a way of you consolidating those together. And for obvious reasons, apart from the fees, it gives you that investment control as well. As there are benefits and considerations, there are some reasons why you may not look to transfer a UK pension to Australia. So one of them is it may not be cost effective. So that will depend on your fund compared to what the costs associated to moving it. So obviously BDH Sterling do have fees, and there may be fees to set up accounts. There may be some tax consequences as well. So we would direct you in that way if it's not going to be cost effective for you to move your money out of the UK. Your UK scheme might be giving you some really good performance returns, and they might be really difficult to match. So we may not be able to put you in a better position if we took it from the existing scheme. Your scheme that you're currently in might have an early exit penalty. So if you withdrew your money in a certain period of time, there may be penalties in you doing that. Therefore, it may not be in your best interest to do so. The other thing which I touched on slightly on the slide before was you may not be comfortable taking on the investment risk. So what that means is if you're in, say, a defined benefit or a final salary scheme where the money is guaranteed, so you'd be giving up that guaranteed income without taking any market risk. And then you would be putting it into an environment that you would have market risk associated with it. It may be something that you're not comfortable in doing so. So that might be a reason why you may not be best for you to transfer out. There are a couple of options in regards to when you can transfer your money from the UK pension to Australia. At the moment, if you are aged under 55, we can't bring the money over into an Australian fund over here. You have to wait at the moment until you're 55 years old. It's probably important to note at this point, it's not legislation yet, but there is a proposal in 2028 to move this retirement age up to 57. So what that will mean is that you would have to obviously wait till 57 after 2028. But at the moment it's on 55, so we'll run with that. But if we were looking to transfer or consolidate your UK pensions, we would look to put your money into a self-invested personal pension or a SIP or a private pension in the UK. Depending on your fund value and what the exit strategy for that is down the track will depend on if a SIP or a private pension would be recommended. That money can be invested in Aussie dollars or in sterling at any point, even if you're under the age of 50 or 55 and we're not looking at bringing it over. Or you can leave your pension in its current scheme and maybe take a bit more control. It might be something we could manage for you. And then when we can do so, we'll help initiate that onward transfer to Australia. So what is a SIP? So a SIP is a personal pension plan scheme. Sorry, a SIP is a self-investment pension plan, personal pension plan. I'm getting all mixed up. Sorry, guys. And it basically allows you to make your own investment decisions. Obviously, they have to be approved by HMRC and the trustees, but you have a lot more control on where your money is invested. They're very similar to self-managed super funds. So in Australia, we have self-managed super funds, which I'll touch on in a little bit on the next couple of slides. But it just gives you more control. And a SIP can be invested in sterling and in Aussie dollars as well. So we can look to eliminate that currency control for you. Benefits of the SIP, I've just given you a couple. So your pension can be in sterling or in Aussie dollars. So if the rate gets good, which is not too bad at the moment, and you wanted to take advantage of that, you could essentially invest your money in Aussie dollars. Your UK pension can also be invested in the currency of choice as well. So if you do trade to Aussie dollars, you can invest in Aussie dollars while it's still in the UK SIP. 100% of your pension can be passed to your beneficiaries. So if you're to pass away, 100% of your money can be left to your beneficiaries. So that's obviously a benefit. And you can have as much input into the investment of your pension as you wish. So we do have to be guided by the trustees and HMRC about what they will allow you to invest your money in, but you do have a lot more flexibility in a SIP. Sorry. Transfer options for 55 and over. So if you are over the age of 55 at the moment, we have got the option of looking to transfer to Australia. So we do look to transfer to a QROPS fund. So some of you may or may not have heard of QROPS. So it is a qualifying recognised overseas pension scheme. Essentially, it's a qualification or a wrapper that goes around a superannuation product in Australia that will allow your funds to be moved from a UK pension into the Australian superannuation environment. If your fund is a qualifying fund, then there are no penalties or tax implications of you breaching any requirements from the UK. We have to move your money in line with the non-concessional contribution limits, which in Australia at the moment, I'll talk about those limits in the next slide. But in Australia, when you put money into superannuation, the majority of that money will be non-concessional. The limits at the moment is 110,000 per person per financial year in Australia. And there is a bring it forward rule you can use as well, which would allow you to do 330,000 and using up your 3 years worth of allowances. or you can leave your money in the UK, in the pension in the UK. So, and you can drip feed it out as an income depending on your taxable income at the moment and your needs and when you need to access that money. The next section I'm just going to go through around QROPS and just talk a little bit about QROPS. If you've got any questions around this, or you can pop it into the Q&A and we can answer that for you. But QROPS is basically a recognised scheme by HMRC. So it will allow the UK pension to go into the QROPS wrapper. It was introduced in 2006. So since then, your fund has to be QROPS, otherwise there's severe penalties by the UK. Up to 55% of your fund, 55% tax charge can be charged if your fund goes into a non-complying fund in Australia. So it's really important that you have that QROPS wrapper if you are looking to move your money over to Australia. It's got certain criteria and requirements that's set out by HMRC. And it is an option for those people only if they've left the UK and they intend to retire overseas, such as in Australia, permanently on a permanent basis. It's not something that you can do if it's just a temporary measure. And there's other penalties and tax charges if that was the case. So I'll show you that in a second. So that's just a few points on QROPS. One thing, actually, sorry, I'll just go back. One thing in Australia, there's only 2 QROPS funds at the moment, or qualifying superannuation funds that have that QROPS wrapper around it. One is a self-managed super fund, and the other one is with Australian Expat Super Fund, AESF. So that's a retail fund or a self-managed super fund. So at the moment, that limits membership to people who are over the age of 55. So it meets that requirement that HMRC have set. And they're basically the only 2 that we can open for clients at the moment. This is a little bit around legislation changes. Now, it can be super daunting because we're talking about UK legislation and Australian legislation. For me personally, the changes that happened in April 2015 were seriously significant for me. I joined BDH Sterling in February of 2015. So all of these changes I'm about to highlight to you all happened within months of my arrival, which was fun learning curve. So the first thing is that you cannot transfer unfunded government schemes. So these were schemes, like I mentioned before, NHS, fireys, teachers' pension, civil service pension, there's some army pensions as well. So you cannot transfer them, they haven't been allowed to be transferred out since 2015. HMRC also introduced the pension age test. So you cannot access your UK pension until age 55. So that was one of the major reasons why Australian funds, which is the next point, lost all our QROPS schemes pretty much overnight. So in Australia, prior to the 6th of April 2015, we lost 1,652 schemes from our QROPS register, and it literally happened overnight. It was there one day, gone the next. The main reason for that was around the early condition of release in Australia. So in Australia, you can access your superannuation through the hardship clause. So if you're going through financial hardships or medical, you can actually access your super, and that's at any age. That breaches the UK rule of being 55. So that's why we cannot bring any money over for anyone under the age of 55 at this point. So that was a very interesting time to be working in the industry. The other thing that happened that year or that time was the FCA required you to receive financial advice by a pension transfer specialist or someone that was licensed to give DB advice on defined benefit pensions for anything valued over 30,000. So that was another thing that they brought into place to protect people like yourselves who have pensions, to make sure that any advice or any changes you make is advice that has been given by a licensed advisor. There was another change that happened in March 2017, and that was around, it was called an overseas transfer charge, an OTC charge. Basically, you had to be a resident of the country that you set up the QROPS in. So if you are living and working in Australia, you must be an Australian resident in Australia to set up the QROPS fund. It was the first box you had to tick. And then you must retain your QROPS status and your QROPS residency for 5 UK tax years, so 5 full years from date of last transfer. So if all your money comes over in 1 year, you must ensure that you remain a tax resident of the country where that money lands, that being Australia, for 5 years. If you do not, there is a 25 tax charge that was introduced by the UK that would be payable on your transfer across. So that's quite significant. So these are all things that we have discussions with you about, and make sure we have got these considered before we look to transfer out of your scheme. The other thing that happened in July 17 is there was a massive change to super contribution caps. So in Australia, there's a couple of ways you can get money into the superannuation environment, but one of those is through NCC caps, which is non-concessional contribution caps. In 2017, those caps were 180,000, and it reduced down to $100,000 per year. That since 2017, it has gone back up to, I mentioned before, 110,000 per year. So the current legislation, non-concessional caps, is 110,000 per year. And there is that bring it forward facility available as well for most people, and that is would be 330 as we currently stand at the moment. So it's basically 3 times your annual allowance. The other thing that changed just the 1st of July this year was the work test in Australia. So to be able to put money into super, there was an age where you had to, after a certain age, be working a certain amount of time before you could put money into super. They actually have removed that work test from July this year. So as long as you're under the age of 75 years old, you can use your non-concessional caps to bring over your funds into superannuation. So that's just a few of them. There's probably a few more since 2015 and previously that we can go through, but we'd be here all day. So as you can appreciate, we're looking at rules in the UK and Australia, so it can be a bit of a minefield trying to navigate through that. So that's obviously a benefit with what we can assist you with. Benefits of a QROPS fund. So your pension would now be in the same country as yourself. So obviously that goes without saying, it creates lots of benefits. Your pension can be also in Aussie dollars. Majority of clients still want, will need Aussie dollars. If you have a need for sterling, there is an option of keeping a little bit of sterling if you're traveling back on holidays and want to be able to keep a bit of your money for that. We have that option. 100% of your pension can be passed to your dependent if you pass away. So I think I've covered that one. Tax treatment benefits. So anything you take out of super after the age of 60 and retired from the workforce is tax-free, non-assessable. So it doesn't make up any of your taxable income. If you left your money in the UK and drew a pension from that, obviously you would have tax that you would pay on that income for life. So by moving it across into a QROPS fund, you get superior tax benefits in retirement. UK and Australian pensions can be consolidated into one fund. Lots of people ask this question: if I bring my UK pension over, can I add my Australian super or my HESTA or my CBUS? Can we put it into one pot and consolidate it together? It's not really a simple yes or no answer. It's something that we would consider for you. There's pros and cons to both scenarios, but first of all, we have to be very careful about what benefits you have in your existing scheme before we can consolidate. But we do have the option of doing that at some point if you wanted to consider that down the track. If you have a QROPS fund, there are certain responsibilities. So this again can be another bit of a minefield trying to navigate through the HMRC website, but there are a few things that you do need to be mindful of, and we do talk you through this if you did engage in our services. So there is a 10-year reporting requirement in any QROPS fund. That is the responsibility of the member and the trustee of the scheme. So for 10 years, irrespective if there's no money left or it's still invested, however the money is, for 10 years, there are certain trigger events that you have to report back to HMRC. If they aren't carried out in the time period set out by them, there are penalties. So it is really important that we are across the reporting requirements. We also have to ensure that your benefits are in line with the UK scheme provider. Another question we get quite a bit is some people like to use their superannuation in Australia to buy investment properties in Australia, so residential properties. UK will not allow you to use pension money to purchase a residential property inside your super. So that's one thing we have to make sure we are aligned with. There's a couple of other things, like you can't purchase any collectible cars, gold or silver, physical gold or silver. So there's a couple of investments that we need to just be mindful of, that you wouldn't have the same flexibility as you would with a normal superannuation fund in Australia. The other thing is that you have to comply with the member payment provision period. So this can trip some people up. So it can get a little bit tricky because it does depend on how long you've been in Australia for. It also depends on when the money came over from the UK. But in a nutshell, in a very high level nutshell, the member payment provision period is 10 UK tax years of non-UK tax residency and 5 years after your transfer to Australia. So what that means is within that time, that is when you need to retain your QROPS wrapper around your product in Australia and make sure it's still aligned with what the UK say you can and can't do with your money in regards to the investments and things like that. So what that means as well for some people is you can't roll your QROPS fund into a non-QROPS fund in Australia if you're still within that period of time. If you do, there are some significant penalties. So again, it's something that we can discuss with you if you've got that specific situation, and we can go through that with you. Okay, so the next section is around the transfer process. So what BDH Sterling can do for clients, or how we may be of assistance to you. So the first sort of step that we do, and you do have an email for attending the webinar today, where you can contact us. There's no obligation to have no obligation fee, sorry, to have any meeting or discussion. So we can talk about your situation, get to understand what you're looking for, see if we are able to assist you moving forward and give you some options. We'll talk about whether you're in the UK still or you're looking at moving over. We'll have a bit of a chat around what your retirement needs are, whether you're retiring shortly or down the track, and we'll review your options with you. If you did engage in our services, we'll go through that process in detail with you before the engagement is signed off, but we do complete what we call a pension transfer analysis report and a full review of your situation. So the report that we give you will be specific to your situation. Everyone's situation is totally different, so we'll make sure we meet all of your goals and needs, and whatever we recommend will put you in a better position. It's very important that we align that with most people it's retirement goal or buying that house or whatever that situation is for you. We review the report and our recommendations, and if you engage with us, we manage the transfer process from beginning to end. As you can appreciate from some of the slides I've gone through today, it is quite complex and there are a lot of moving parts. So we will manage that with you and keep you informed along the way as we go through that process. Why should you seek advice before you make any decision? It's around the tax constraints, super changes in the UK and Australia. So we're across all the rules and regulations, even the ones before they are made law. We're across it and we're already thinking of ways that we can help our clients achieve their goals. If you don't do it right, there are penalties. So it's not a scaremongering thing or anything, but if you do a transfer that's not compliant, you can lose quite a significant portion, up to 55% of your fund if it goes to a non-compliant transfer. And we also will confirm if your pension is recommended to transfer out. So something I probably haven't talked much about on this slideshow, but sometimes we may recommend that you keep it where it is. So it is really important that we confirm that with you, the reasons why we do that. Okay. So why BDH Sterling? So BDH Sterling are dual licensed advisors. So you can tell by my accent, I am Australian. I was born here. The rest of my family is Scottish, but I'm first one here in Australia. So I'm a qualified Australian financial advisor. We also have pension transfer specialists and chartered financial advisors in the UK, and they are based in our Perth and Sydney office and Melbourne office. So we are defined benefit pension specialists. The advice we provide is all under one roof. We don't do anything outsourced. Everything we do goes through our global office. We've got office in Epsom in the UK, and we've obviously got our Australian offices here as well. So everything we do is in-house. None of our financial advice is outsourced to anyone else. We can also provide advice in other services. We're qualified to give advice on Australian superannuation. There's BDH tax that we can refer you to if there's specific tax questions you have. We have a risk specialist in BDH Sterling. That's around life insurance, income protection, that sort of thing. And retirement planning, we can give you financial services and advice on that as well. And the last point on there is we do have over 15 years experience in UK pension transfers. And for 15 years, that has been done all in-house as well. So that's something we're pretty proud of in regards to that. So if you've got any questions, I know there's a few questions in the Q&A box, which we're going to go through in a second with Brendan, but any questions you can direct to the inquiries at bdhsterling.com. We're more than happy to pick up the phone, send an email, have a Teams call, meeting in person, have a chat with you about your situation. You can send us a little bit of information about yourself so that we can have a really in-depth conversation about how we may be of assistance and guide you through a overwhelming time, I suppose, 2 different countries, 2 different rules and regulations. So we'll go through some Q&As now.
Yeah, so I'll jump in. So thanks, Rebecca, for taking us through the contents of the presentation there. And it is certainly time to go through some questions, and we've had a few come through. So just a quick reminder for those that do want to ask questions, Q&A link down the bottom there. Please feel free to type your questions in there and we'll try and get through as many as possible. And again, quick reminder, if we don't get through all the questions, we will come back with any specific answers to the queries post the webinar. So the first one that's in there, we might start off there. It's in relation to the SIP funds. So Beck, I'll give this one for you. Can you say a little more about transferring SIP funds already in drawdown? So i.e. where the individual's already taken the tax-free 25%.
Yeah, so I'd encourage you to reach out and we can have a chat with you. But even if you've taken your 25%, your fund probably is crystallised, which means you may have some restrictions on how much you can access and that sort of thing. And depending on how much it is, you may or may not be able to use the non-concessional caps, but you still have that flexi access drawdown. So you still should be able to access it. And it may be a different tweak to the strategy or something slightly different we do for you. But there still would be benefits in you reaching out and having a chat with us, and we can talk more specific about how we do that and what that would look like for your situation.
Perfect. So in the similar theme around SIP funds there, so if you transfer SIP funds into a QROPS, can you then take the full advantage, the full amount out immediately tax-free? And how does the UK lifetime allowance affect the transfer process?
Okay, so the UK lifetime allowance is probably another layer of complexity, but it does affect it because obviously, well, if you go over your allowance, you'll have tax consequences in the UK. So there are some different strategies we do for clients around that. But in regard to the question around accessing it once you move it to QROPS, if you are 60 and retired from work, you have met what we call in Australia condition of release. So you can access your superannuation, and you could essentially, and this is with major disclaimers, this is not what I'm telling you to do, but you could essentially withdraw all of that out of super, buy a yacht, travel the world, do what you want to do with it, as long as it's going to meet your retirement goals. But yeah, you can access that from your super if you've met those conditions.
Okay, thank you. And again, there's a bit of a theme on the SIPs there. So if you take a tax-free cash lump sum from a UK pension, either in a SIP or the defined benefit scheme, will it be taxable in Australia?
It will if you're an Australian resident for tax purposes. It will be taxed. So if you took a lump sum of $20,000, that would be added if you're working or to your assessable income, so it will have tax on the growth component. So it does have a tax component on that. Again, if you reach out to us, we can give you a little bit more information on that, or refer you to BDH Tax if you want to have specific tax advice on that. But it is taxable, unfortunately.
Yep, the taxman always gets his little clip. So the UK defined contribution pot equates to about $1 million in Aussie dollars. Does this mean it'll take 6 to 7 years to transfer to Australia given the annual limit?
Not necessarily. So one thing I didn't spend much time on is when you do move your money from UK to Australia, there is a growth component, which is how much money your pot in the UK has grown by since you left the UK and became an Australian resident. So whatever that growth component is, a taxable component on transfer, and that will go in, and that doesn't make up part of your non-concessional limits. Like there is ways of accessing lump sums that you can take it as you come through, and you can use your bring it forward rule. So we may or may not be able to get it out in 1 year, but we could do it maybe over 2 years using the bring it forward rule. And there's a couple other strategies we could look at as well for you. So again, yeah, if you give us an email, we can have a chat on the phone about it in more detail.
Excellent. So this is an interesting one, and around residency. I'm happy to give a bit of context to this because it is a complex area. So do you have to be a permanent resident to use a QROPS, or does it apply to temporary residents on a bridging visa? So I think there is a lot of complexity around this, and I'll get Beck to add from her experience as well. Yes, as a temporary resident, you can actually start a superannuation fund within Australia. The issue that you have is being a temporary resident, whether you can actually get funds back out of that or take an income stream from that in later periods of time. So it is complex in that. Again, similar to what Beck's mentioned before, seeking advice on what you can do and what that would mean. And because there are a lot of different types of visas as well, and visa types, certainly something which is important to get advice and direction on. Beck, is there anything you'd add there from your experience?
Yeah, so yeah, Brendan's right. You can open it. There's nothing stopping you. It's about when and how you can access that. And if you have a pathway to PR, if for some reason PR was not granted and you never could get it, you may have some serious issues with accessing that money from super because of the rules in Australia on that. So yeah, so it's a two-part question. Nothing stopping you doing it, but getting your money at the other end may be a bit trickier than you may have considered. So yeah, grab advice on that one.
So this is a long question. I'll try and break it into some components. So would the transfer or transfers from a UK personal pension plan to an Aussie QROPS, so i.e. the initial amount allowable for NCC and then the amounts post that, reduce the UK charge to tax that would otherwise arise on a UK pension plan whose value is in excess of the UK lifetime allowance? Bit in that one, Beck, I hope it makes some sense.
Yeah, I'm just having a look at the next page. So it's a two-part question because the lifetime allowance limit, yeah, I'll probably have to get back to you on that one. It's probably a bit tricky to answer in this open forum.
Yeah, I thought I'd throw that one and give it a shot, but it is probably a bit complex.
It's a good question. I know the answer, but it's probably not something I could do now. So we can probably organise a call with our PTS and we can go through that.
And we have the person who contributed that one, we have your details there, so we can certainly come back to you. There's a couple of questions in there around, will this be recorded? Absolutely, this has been recorded, and we will send out the recording within about 48 hours from now. You will certainly be have that sent to your email address as well. There's a question in there, what experience do you have with AESF, the only QROPS retail fund? Do you recommend it if it is, if a QROPS SMSF is not suitable? One of the things we certainly do is we look at each client situation in the context of what's right for them and under the best interest duty that we operate under. So there are certainly clients where a SMSF is not going to be suitable due to one, the fact that they don't necessarily want to be in control of making all the decisions of what's required for a trustee of an SMSF. Second, the balance comes into play as well. So the cost of having an SMSF compared to being in a retail fund. So our experience with AESF is fine. And we certainly would look at an individual case to see whether that was suitable or whether the whole mix of reasons why an SMSF might be suitable for a client as well. But again, it's a case-by-case basis. We would certainly have people who may have, larger sums where the retail-based QROPS fund would be suitable for them because they don't want to have the hands-on dealings. They want to be able to leave that to a separate trustee to make those decisions and answers. Yeah. Quick and easy one for this one, probably Beck. So on the QROPS, can you draw down on these?
Yes, you can. So as long as you've met condition of release. So the QROPS is really just a wrapper around a superannuation product. So once, like I said before, if you're 60 and fully retired, you've met full condition of release. So you can draw down what is required for you throughout your retirement. So yes, you can draw down on that.
Excellent. And we do talk around this within the industry a little bit. The boomerang Brits, or as referred to at times, the ping pong POMs. So if we transfer a UK pension to Oz and then return to the UK at some stage, can we transfer the super pension back to the UK?
No. So it's important that once you come out of a UK pension and bring it over, it is a one-way transfer. You can't then put it back into the scheme. You'll still have access to your money, but obviously it is something we do. So we have a lot of clients that come to us when they're on their way back to the UK, or they've been clients of ours for 5 or 6 years and now they decided to go home for whatever reason. So it is something we can give you advice on, but it is a one-way transfer as far as not being able to put it back into that pension environment that we draw it from.
Oh, perfect. And then in what instances would you recommend to leave UK pensions in the UK rather than transfer to Australia?
It's a good question. So one would be if it was a defined benefit or a final salary and the income that was on offer and the benefits with that scheme was can't be matched by anything we can do, we would say stay where you are, and these are the reasons why, and explain how and when you'd access that money. Another reason might be if your taxable income was nil, or you were looking to retire soon, you wouldn't have any assessable income in Australia. Your pot, depending on the size of the pot of money, you might be able to drip feed it underneath tax allowances and things like that. So there might be a better way for you to do it without having to move it through the super environment. So it would just be a case by case. Yeah.
Yep, excellent. Just following on from the previous QROPS SMSF question, what balance would make a QROPS SMSF worthwhile? There's a lot of talk in the industry around that. Years ago, it started $150,000 was where it was becoming viable for a self-managed super fund. Really, in today's environment, it is that 300,000, maybe 400,000, that sort of amount where it becomes more viable for a self-managed super fund. From a cost to manage and administer the fund compared to a retail fund there. So certainly looking at a couple $100,000 before the SMSF would be worthwhile. And that's, to be honest, we're talking about UK pensions potentially coming across. That would be the same as if it was someone in Australia, been working in Australia forever and a day. And we would look at the same sort of methodology and balances around that there too. Simple, easy question. I like these ones. What if you're already retired? So the assumption would be already retired in the UK and looking to move out to Australia.
But you still got all the different options. So even if you've retired, I'm assuming you may or may not be drawing an income from your UK pension at the moment. So depending if you're doing that and what other assets you have from a tax position, it may be, we'd still assess and have a look at it for you and maybe suggest you stay where you are, or you may still be able to bring it over and put it into super and start a pension straight away from superannuation. So it's really just around understanding your situation, you know, what your objectives are, and then we'll make sure we recommend the best solution for you. But retired and still in the UK shouldn't deter you from looking at your options.
Excellent. So we'll probably do two more and then wrap up. So this question is, if your transfer value from a defined UK pension is greater than the 330,000 bring forward and you want to transfer the full amount to an SMSF, how is the additional amount treated?
I'm just going to grab. Is that one in the forum? I just want to grab those numbers again. Sorry, Brenton.
So right down the bottom, that one will be.
Okay. Okay, so if you put more than your non-concessional, it's not something we recommend at BDH Sterling. So we always recommend our transfers are within your non-concessional contribution limits. If you transfer more than you're allowed to with your non-concessional in Australia, there are tax consequences and breach consequences of doing that. So that doesn't always put the client in the best position by unintentionally or intentionally breaching those limits. Like I mentioned earlier, depending on the pot of money, the 330 is just the non-concessional component. So you can drip feed that over a couple of years. So you could do 110 one year and 330 with the 3 year, bring it forward the following financial year. There's a couple of different things that you can look at and you can consider, but over contributing the non-concessional is not something we typically do at BDH Sterling.
Yep, absolutely.
There is a, I think, Brenton, or?
I think we've got it on that one. There is one last one in there. CTV from defined benefit pension scheme has been received recently, and it's halved in value and doesn't seem worth moving right now. Any views on recovery of values from us interest rates and gilt seem to be the main driver. Yeah, it's a difficult one. It may be yourself, whoever has submitted that one. We did have this question come up from the team during the week, and we've been seeking a little bit further information to try and understand that ourselves. I think one of the things from an advice point of view, if a CTV had halved in value, we would probably be putting a bit of a holding pattern on what the reasons were for that and whether there would be indications of recovery and what that would be. Obviously, it's a bit of a shock when those come through and they're a big drop in value. So I think it's hard for us to have an opinion on that right now, because a lot of defined benefit schemes are different and it's not a broad brush around all defined benefit.
Yeah. Half is quite, sorry to cut you off there, half is quite significant. So I would encourage you, if you've had previous values, to do a bit of a comparison to make sure that the value they've given you has all of your benefits included. Sometimes you do see that some of the components may have been calculated or dropped off or missing, but we are seeing a drop in value because of the interest rates like you mentioned. But I would encourage you can have a chat with us and we can explain some things to look for. But like Brenton said, it's something we would need to consider whether you want to look at bringing that out now or not. But making sure it's the right value to start with is important.
Yep, absolutely. All right, so we will look, there's a few more questions in there, so we'll look to come back to the individuals who have submitted those separately. So thanks again to everyone who's taken some time out of your day to attend. We trust the session information has been useful to you. The recording will be made available over the next 48 hours and will reach direct to those who have had specific questions in there. I would encourage you, please, there is a survey monkey, so a BDH webinar feedback survey, which we will be conducting. Encourage you to please keep an eye out for that. We do value your feedback, and your time in filling that in is greatly appreciated as well. For those of you looking to seek advice on what your situation may allow, please feel free to reach out to us at inquiries@bdhsterling.com, and certainly Beck and the rest of the financial planning team will be keen to be able to try and help out and give you some great advice and assistance in what may apply to yourself. Once again, on behalf of BDH Sterling, thank you for your time and all the best for the rest of your day.
Thank you.